So how I want you to think of business in this reading, that every business will typically have two types of cost. Now in accounting, we divided those costs in COGS, in selling general and administrative expenses, depreciation and interest. This was more or less functional classification. But now we are not on the accounting side. Now we are on to the corporate finance side, where decision making side. So we would be dividing this cost into variable cost and fixed cost. Variable cost means that cost which increases with the size of business. So let us say you are paying hourly wages. Right? So the more manufacturing you do, the cost that you pay towards wages increases. That would be variable cost. Fixed cost is that cost that does not increase with the size of the operations that you do. I think a good example here would be monthly rent payment. Right? Irrespective of how much sales you make, your rent payment are going to be constant. This fixed cost we will further divide into two parts: operating and financing. So an example of operating fixed cost would be rent. Another example of operating fixed cost could be, let us say, salary, at least in the short term. And can you think of example of financing fixed cost? It would be interest. Now the rule of thumb is, in any business model, if your business model inherently requires you to have a large amount of operating fixed cost, then what businesses will try to do is, they will try to keep their interest costs at minimum so that your total fixed costs are at a reasonable level. But if your operating fixed costs are lower, then it is okay to leverage your business and increase your financing fixed cost. But at any point of time, it would be very risky to have large amount of operating cost and large amount of financing cost. So what happened with Subiksha is, the retail business model inherently in India requires you to pay large amount of real estate cost. Agree? Plus there are large amount of salaries, and both of these costs are fixed. So Subiksha already had large amount of operating fixed cost. When they kept on taking debt, they also had large amount of financing cost, and therefore when the sales reduced, they still had to pay these expenses, and then they started defaulting and the company collapsed. Is it fine? So the risk that exists because you have a large amount of operating fixed cost, this risk we call as operating leverage risk. And the risk that exists because of large amount of financing cost, we'll call this as financial leverage. Are we okay here? So write down this part quickly. Done writing? So I was reading through these case studies again some time back, but I was trying to build a different perspective. I think the name of the promoter was Subramaniam. Something like that. He was South Indian. And apparently he was very smart. Okay, so what I was thinking is, why is it that he could not, this is a simple topic that you people learned in 10 minutes. Why is it that he could not understand that he was adding up too much of leverage to his company? And of course he must have built a really good finance team. So why could not they identify? So when I was reading through, I understood that, the business environment in India in those years, 2003, 4, 5, 6, 7, that was kind of a IPO boom area in India, isn't it? We saw so many equity markets were doing good, and we saw a large number of IPOs kept on hitting the market. So his planning was that in 2008, he wanted to come up with an IPO, and in the IPO he must have raised large amount of equity amount, and using that equity amount, he wanted to pay off large amount of debt so that the financial leverage of the business would have reduced. But in 2008, suddenly the market sentiment changed, and it was very, very difficult for company to come up with IPO in that kind of market. So it was also some sort of a negative luck that works against him. So now let's do an example. The variable cost will, maybe you ask me this question after some time when you have better understanding. The question he asked, will variable cost be automatically covered in both the leverages? The question maybe can be framed better. But after this example, it will make sense to you. Let us say that sales of an organization right now is 1000 minus, write this in the middle of your page so that there is some space on the left and some on the right, less the variable cost. Let us say variable cost here is 600. So sales minus variable cost, this number is called as contribution. Okay, why is it called as contribution? We'll keep that discussion on hold. So sales minus variable cost, that gives us contribution of 400 less operating fixed cost. Operating means fixed cost but related to business model, rent, salary, whatever fixed cost that you have. Let us say that is 200. And then that would get us contribution minus operating fixed cost. This would get us EBIT, and EBIT is also called as operating profit, earning before interest and taxes. Operating profit, same concept. So EBIT of 200. Now this is our base income statement. Let us say now firm is successful in increasing the size of revenue next year. So now next year your amount of sales, just going to write the amounts here now, is 1500. What is the percentage increase in sales? Percentage increase in sales is 50%. Now if sales have increased by 50%, what is your prima facie intuition? Operating profit should also increase by 50%. Correct? Yes or no? No? Why? Because your operating fixed cost will not increase in proportion with sales. So which means if your sales has increased by 50%, your operating profit will increase more than proportionately. Let's see how much. How much should be the variable cost? 900. How did we get that 900? Variable cost is 60% of sales. Make sense to you? So now your contribution would be 600. But your operating fixed cost will not increase. In fact, that's the assumption, that we are not letting the operating fixed cost change. So now operating fixed cost is 200. Once that happens, then we will have a EBIT of 400. And what you can clearly observe here, your EBIT has actually increased by 100%. So, an increase of 50% in sales resulted in increase in 100% into operating profit. This 2 number that we have right now, this 2 is called as degree of operating leverage. It is giving us the sensitivity between if percentage of sales changes by X%, by what percentage your operating profit will change. So the meaning of this number 2 is, if sales increase by 10, operating profit will increase by 20. If sales increase by 5, operating profit will increase by 10. If sales increase by 30%, operating profit will increase by 60%. That relationship of 2 would be intact. Following this? Now it works on the other side as well. Okay, so let us say now that sales have become 750. Now that's a decrease of how much? 25%. So now with our previous logic, if sales have decreased by 25%, we will expect operating profit to decrease by, if sales decrease by 25%, operating profit should decrease by 50%. Let's see if that works. Less variable cost, tell me how much? It would be 450. That would get us contribution of 300. Fixed cost would be how much? 200. Again, as the level of sales is changing, your fixed cost is not changing. And now we have EBIT. In this case, EBIT is of 100. So from 200, your EBIT has become 100, which means there is a decrease of minus 50%. So again, the relationship of 2 is intact. And this 2 in this case, of course, is called degree of operating leverage. Okay, so write down the formulas for degree of operating leverage here. Degree of operating leverage is equal to percentage change, this is a delta sign, percentage change in EBIT divided by percentage change in sales. percentage change in EBIT divided by percentage change in sales. There is also an alternate version of formula available, which is contribution divided by earning before interest and taxes. Contribution divided by earning before interest and taxes. Let's see if it works. Percentage change in EBIT, how much here? 100%. And percentage change in sales here was how much? 50%. How much is that? 2. Or percentage change in EBIT here is minus 50%. Percentage change in sales is minus 25%. Again, it is 2. Or contribution here is how much? 400. EBIT 200. Again, degree of operating leverage in this example would be 2. Is it fine? Now, this 2 will work on your base income statement. Degree of operating leverage is not a constant number. It changes on every income statement, which means if you calculate degree of operating leverage here, it would come out to be a different number. Do you see this? 600 divided by 400, it would be 1.5. And if you would calculate degree of operating leverage here, it would be 3. It will remain only constant when you are at your base income statement. At every level of sales, you will have a different degree of operating leverage. Are we okay? Yes, no? So let's go to next step of this calculation. So heading in your notes, degree of financial leverage. Degree of financial leverage. So again, I'm building an income statement. But this time my income statement will start with EBIT. So base level income statement, EBIT is 1000. Less interest, 500. That would get us EBT. EBIT is earning before interest and taxes. EBT is earning before taxes. EBT would be how much? 500. Less taxes. Let us say tax rate is 40%. So less taxes 200. And then earning after taxes. And earning after taxes, we can also call this as net income. Or we can also call this as PAT, profit after taxes. Same concept. Earning after taxes, net income, profit after taxes. All of these would mean the same thing. So here your earning after taxes are 300. Now let us here increase your EBIT and let us make this as 1500. That's an increase of how much? 50%. Can I make a statement that if EBIT increased by 50%, your earning after taxes will also increase by 50%? Can we say that if EBIT increases by 50%, earning after taxes will also increase by 50%? Yes or no? No, because when your EBIT will increase, what will not increase is interest, and therefore your profit will increase more than proportionately. So your interest will remain constant, 500. That would get us EBT of 1000. Taxes would be of 400, which will get us earning after taxes of 600. And again, this is increased by 100%. We have a relationship between these two values of 2. Now it works on the other side as well. Let us say EBIT now has become 800. That's a decrease of how much? That's a decrease of 20%. Will interest change? Interest will remain same amount. So interest 500. That would get us EBT of 300. Taxes would be 120. This would get us EAT of 180. And from 300, it is 180. That is a decrease of 40%. So again, the relationship of 2 is constant. Okay, 2 in this, it is just an example. It is not necessary. It is always 2. In our example, we are intentionally setting it as 2 so that it's easy to calculate. Are we fine here? And this impact now is called degree of financial leverage. So let us write down the formulas. Degree of financial leverage is equal to percentage change in earning after taxes divided by percentage change in EBIT. This is the first formula. An alternate formula is earning before interest and taxes divided by earning before taxes. So if you want to see the application, 100% divided by 50%, which is also same as minus 40% divided by minus 20%, which is also same as 1000 divided by 500, here and here. Are we clear with this? So what DOL and DFL are doing for us? Done writing? So DOL is showing us the relationship between percentage change in sales and percentage change in EBIT. And hypothetically, let us say if DOL of a organization is 3. If sale changes by 1%, EBIT will change by 3%. If sales changes by 8%, EBIT will change by 24%. If sales decreases by 15%, then EBIT will decrease by 45%. And degree of operating leverage is happening to us because of existence of fixed operating cost. Make sense? In the same fashion, degree of financial leverage. So degree of financial leverage, it shows us the relationship between percentage change in EBIT to percentage change in EAT, earning after taxes or net profit. If degree of financial leverage is 2, 5% change in EBIT will increase your EAT by 10%. 20% decrease in EBIT will decrease your EAT by 40%. And degree of financial leverage is happening because of existence of fixed financing cost or simply the interest cost. Is it fine? So now let us build a comprehensive flowchart. Done writing this? Write fast. As of now, we're just discussing how to calculate these numbers. Once I'm done with this part, then I'll show you the real life implication of these values. Done with this? So now let's build a comprehensive summary of these set of calculations. Let us say now we'll have the entire income statement together. So we will start with sales. Let us say 1000. Tell me, sales minus variable cost. Let's keep that as 200. Sales minus variable cost, what will we get? Contribution. Let us keep that as 800. Less, what should we reduce now? Operating fixed cost. Let me keep that as 400. What do we get now? EBIT. Earning before interest and taxes, which is also called as operating profit. That would be 400. Less interest. Let us say it is 300. Less earning before taxes. So this is 100. Now we would say less taxes. Let me keep it as 50% just to keep things easy. And then finally it would get us earning after taxes of 50. Now in the first step, we would calculate degree of operating leverage of these values. So degree of operating leverage, as we know now, shows us the relationship between sales and EBIT. And we have so far seen two formulas. First formula, percentage change in, tell me, percentage change in EBIT divided by percentage change in sales. Now, this formula is more or less the application formula, not calculation formula. Meaning of which is, once you calculate a DOL of 2, then you would read that formula in this fashion, that if sales changes by 10%, EBIT will change by 20%. The true calculation formula is contribution divided by EBIT. In this case, contribution is 800, EBIT is 400. That would get us degree of operating leverage of 2. Is that fine? Then, the relationship between EBIT and EAT, this relationship would be given to us by degree of financial leverage. So, first formula is percentage change in EAT divided by percentage change in EBIT. Percentage change in EAT divided by percentage change in EBIT. Second formula is earning before interest and taxes divided by earning before taxes. So 400 divided by 100, degree of financial leverage here is 4. Are you fine with this? Now let's see the beauty of these numbers. Now imagine this is income statement of Subiksha. Sales changed only by 10%. So there is a 10% changes in sale. By how much your operating profit will change? 20%, because there is a degree of operating leverage of 2. Now your operating profit changed by 20%. By how much your earning after taxes will change? 80%, which means a simple 10% decrease in sales can reduce your operating profit by 80%. This is the magnifying impact of leverages. So when a business keeps both DOL and DFL very high, the effect gets magnified because DOL changes your EBIT significantly, and then DFL converts that change in EBIT into change in EAT with more than the higher magnitude with whatever the financial leverage is. So this direct relationship that we see here, which is between sales and EAT, this direct relationship is called degree of combined leverage or degree of total leverage. And the simple formula is degree of operating leverage multiplied with degree of financial leverage. So in this case, it would be 2 into 4, which is 8. Any questions you want to ask? Please ask. Anything not clear? See, what is the formula for DOL? Contribution divided by EBIT. Contribution divided by EBIT. Now let's see the practical application of these concepts. See, when I studied these for my exams, I first did them in CA inter course, and I did them mechanically. I just mugged up the formula and somehow managed to pass the exam. Then I did them for level 1 and I also did them mechanically. For many years, this did not make sense to me. I mean, from an intuition perspective, fine, this part is easy to understand, right? But how do you apply this in a real life perspective? But imagine now, let us think of from a business perspective. I was doing a session some time back, which was finance for entrepreneurs. And there's one very popular courier service, I think, Pardon, have you heard of them? So this gentleman was attending the session and we were discussing on leverages. Okay, so this is now a courier business. Now see how it works. Maybe let's take an easier example. Let's think of a handicraft business right now. We'll go to courier again. So let us say you have a business where you have a shop at a tourist place and you're selling these souvenirs or these handicrafts. Now your current business model is that you purchase these handicrafts at a price of 50 and you sell them. So your selling price is 100. Okay, imagine that for the time being there is no rent attached. Let's say it's your own shop. Now, if you build income statement for this company, you would say sales, whatever the amount is, let's say 100,000. Variable cost, it has to be half, 50,000. Contribution, 50,000. What should be the fixed cost? In our example, 0. Fixed cost 0. So now your EBIT is 50,000. What would be degree of operating leverage? What is the degree of operating leverage for this organization? Degree of operating leverage is 1. Why is it 1? Contribution divided by EBIT, 50,000, 50,000. If your sales increase by 20%, profits will increase by 20%. Why? Because he does not have any exposure to fixed cost. But imagine, instead, he decided that right now what he does is, every time a customer comes, he goes to the wholesaler, he purchases that at a price of 50 and then he sells. But he said, instead, let me set up my own manufacturing plant, so that going forward, I will produce all these 7 years by myself. Okay. Once I do that, then let us say you would have a fixed cost of 30,000. This fixed cost you will have to pay every year, but your variable cost will now come down to 30% as against previous 50%. Are you following this? Now you are producing it by yourself. Now what would be his income statement at same level of sales? So now sales is 100,000. Variable cost this time should be 30,000. Contribution now 70. Fixed cost now 30. And now we would have his EBIT as 40,000. EBIT has come down. Now let us calculate what is his degree of operating leverage. Tell me how much. Contribution divided by EBIT, 1.75. Now at current level of sales, his total profit is lesser. He will have to decide. Now imagine he's not started doing that. He's still considering what decision that entrepreneur will make. He will ask himself, how do I see my revenue increasing in next year? Do I feel that my revenue will increase by 20-30%, or do I feel that my revenue will remain constant, or is there a possibility of revenue decreasing? If he feels that my revenue is going to increase, then he would be better off getting into this business model. Because if your revenue increases by 20 or 30%, then his net profit will increase, or his operating profit will increase more than proportionately. Are you following this? But if he is of the opinion that my revenue would remain volatile, which means it can either increase or it would decrease, then he would be better off remaining in this model, because then if revenue decreases, that means if sales decreases, his operating profit will not decrease more than proportionately. This is how businesses try to manage their operating leverages. Generally, it is easy to move from here to here, but it is really difficult to move backwards. That means it is really difficult to reduce your fixed operating cost. Now think of IT companies. With IT companies in India, they do outsource work. What is the biggest cost to them? Employee cost. Is that a fixed cost or variable cost? Employee is a fixed cost. And because employee is a fixed cost, most of the IT companies have high degree of operating leverage. Do you agree? Which means if their sales reduce by 10%, with a degree of operating leverage of 3, their operating profit will reduce by 30%. So what these companies do is, they would try to forecast what is going to happen to my revenue next year. If it is going to increase, then it makes sense to recruit more employees, because recruiting more employees means I'm adding up to my DOL, and I'm adding up to my DOL. When my sales will increase, automatically my profit will increase more than proportionately. But if I feel that my revenue next year will decrease by 10%, then the smart strategy is pink slips. The reason why IT employees the companies are really sensitive to fire the employees is because they understand that if my revenue decreases next year, because my DOL is very high, my profit will decrease substantially. So let us get rid of these employees so that I can reduce down on fixed cost. And typically the employees who get sacked are the ones at the higher level. Rather than cutting down on employees at 500,000 per annum, 600, you look at the big fishes and instead of 5, maybe eliminate 2 and just have 3 with you. So now, this is now testable sentence for you. This part I want you to write down again. Now we would build pie charts here. Let us say this is your total cost of 2 organizations. Okay, don't write for a minute, just understand. If I tell you that fixed cost of first organization is 100,000 and fixed cost of second organization is 500,000, which one will have more degree of operating leverage? Let me call this as A and let me call this as B. Which company will have more degree of operating leverage? B. How many of you feel B? Because it has got higher amount of operating fixed cost? We cannot say. Operating leverage is not the amount of fixed cost that we have. Operating leverage is, so this is my total cost. Let us say with the first company, this shaded area that I have here, let us say this part for the first company is fixed cost and this part is the variable cost. But for the second company, let us say this part is the variable cost and this part is the fixed cost. So compared to your total cost, since the proportion of fixed cost is higher, this business would be on high leverage, whereas this business would be on low leverage. Is that making sense to you? Think of a simple shop. Let's say you take that shop somewhere on Fashion Street here and you're paying a monthly rental of, let's say, 100,000. If you're making sales of only 150,000 or 120,000, then you're operating at a really high degree of operating leverage because your volumes are really less. But if you're making sales of, let's say, 1 million or 10 million, 20 million with the same rent, then your fixed cost as a proportion to total cost is very small. Then you're operating on a low degree of operating leverage. So we always see this in the context of what is your fixed cost and variable cost as a proportion to each other. Is it fine? So write this down quickly. Let us say sales price or selling price per unit. $100. Variable cost per unit 40. Operating fixed cost 10,000. Interest 10,000. Tax rate 40%. Number of units sold 500. Calculate degree of operating leverage and degree of financial leverage. Let's do this together. Starting point is sales. 100 into 500, total amount of sales would be 50,000. Then variable cost. 400 into 500, how much? 20,000. Sales minus variable cost, we would get contribution. So contribution here would be 30,000 less, what should we reduce now? Operating fixed cost. How much is that? 10,000. That would give us EBIT of 20,000. Interest 10,000. EBT 10,000. Tax 4,000. Earning after taxes 6,000. Then we would calculate DOL, which is contribution divided by other way around. Contribution divided by EBIT. Contribution was 30,000. EBIT was 20,000. It would get us 1.5. DFL, which is EBIT divided by EBT. EBIT is 20, EBT is 10, this would be 2. Degree of combined leverage, 1.5 into 2, it would be 3. And how do you read these numbers? If in the next year sales increases by 10%, then operating profit will increase by 15%. If operating profit increases by 15%, then your net profit will increase by 30%. Degree of operating leverage, relationship between sales and EBIT. Degree of financial leverage, relationship between EBIT to EAT. Next concept. In your notes, break-even points, or let's call this as break-even or quantity. Let us say there is a tea vendor, there is a small tea stall. Every day he pays a rent of 100 so that he can use that small tea stall. Each cup of tea is being sold. So selling price, just to keep things easy, I'm inflating the price a little bit. Let us say is 15. And the cost at which that tea is being prepared, let us say is 5. So in the morning he sets up his stall. He pays rent of 100. He sells first cup of tea. Can I say that he's made profit of 10? No. If he sells first cup of tea, we will say he's made contribution of 10. Do you agree? Selling price minus variable cost. Now why is it called contribution? Because this 10 is going to help you recover some part of your fixed cost. Make sense? Then he sells the next one and now the contribution would be 20. He sells the next one, contribution would be 30. He will have to keep on selling at least 10 units so that he'll be able to recover his entire fixed cost. So this 10 units is his break-even quantity. And we can put this into a formula. We can say operating break-even, I'm writing that formula here. Operating break-even quantity is equal to operating fixed cost divided by contribution per unit. So in our example, operating fixed cost was 100 and contribution per unit was 15 minus 5, 10, and therefore his break-even quantity was 10 units. Is that easy? Now what if he has to pay rent of 100 every day plus every day he has to pay interest of 100? Then his operating break-even will still be 10 quantity. But will that be his total break-even? No, because to reach total break-even, he will have to also recover the interest cost. So next formula, total break-even quantity is equal to operating fixed cost plus financing fixed cost divided by contribution per unit. So in this case 100 plus 100 divided by 10, it would be 20 quantity. Are we fine with this? Now at 20 quantity, he will reach break-even point, which means his total profit would be 0. But what if he sells 21 quantity? Then his profit ignoring taxes would be how much? 10. If he sells 22 quantity, then his profit ignoring taxes would be 20. Are you following this? So now let's do an example related to this concept. Let us say selling price per unit. Selling price per unit is 250. Variable cost per unit is 150. Operating fixed cost is 15,000. Question number 1, we want to know operating break-even quantity Question number 2, operating break-even sales. And question number 3, quantity to be sold to earn a profit of 5,000. Yes, so operating break-even how much? So we will simply say total fixed cost 15,000 divided by contribution per unit. How much, Prashant? Contribution per unit 100. 250 minus 150. That would get us operating break quantity of 150 units. Easy? Then break-even sales would simply be 150 units multiplied with 250. How much is that? $37,500. And quantity sold to earn a profit of 5,000. So now we would say fixed cost of 15,000 plus we want to earn a profit of 5,000 divided by contribution per unit 100. That would get us 200 units. Easy? Next question. So we'll practice 2 more questions on this, but next one is slightly different than the earlier one. Let us say an organization has operating fixed cost of 100,000 and variable cost ratio is 75%. Find out break-even sales. Break-even sales. Yes. Let's do it together. Now, I don't want to throw a formula at you. Let's understand the intuition first. We want to reach break-even sales. Now, let's see how the income statement is built. We say sales minus variable cost is contribution. Minus fixed cost is EBIT. In this case, to reach break-even level, we have to make EBIT is equal to 0. Isn't it? When EBIT is 0, that time you've reached break-even. So which means contribution minus fixed cost should be 0. So your break-even level would be achieved when contribution and fixed cost would be same. Makes sense to you? So when contribution and fixed cost is same, automatically we've reached break-even level. In this case, we know that 100,000 is a fixed cost. Therefore, we also know that contribution should be how much? 100,000. So if we can achieve that level of sales at which contribution is 100,000, automatically we will reach break-even level. Now imagine, let's say the amount of sales multiplied with what percentage of sales should be the contribution? What percentage of sales should be contribution? See, if you make sales of 100, if your variable cost is 75, that's why we have a variable cost ratio of 75. If variable cost is 75, contribution would be how much? 25. So if variable cost ratio is 75%, then contribution as a ratio to sales would be 25%, which means whatever sales you make, 25% of that amount is going to be contribution. So sales into 25% in this case, this amount we want equal to 100,000. And therefore we want break-even level of sales as 100,000 divided by 25%, which would be 400,000. Right? So this is your formula. Formula is break-even level is equal to, let me write that formula here, fixed cost divided by PV ratio. And PV ratio is calculated as contribution as a ratio to sales. Full form is profit volume ratio, and it is calculated as contribution as a ratio to sales. Okay, but don't mug up the formula, understand the intuition how the formula was derived. If your sales is 100, a variable cost ratio of 75% means 75% of that would be variable cost, which means 25% of that would be your contribution. Sales is made of variable cost and contribution. So whatever is the sales, 25% of that is going to be contribution. But since we want to have break-even level, your contribution and fixed cost should be same, which means your contribution should be 100,000. So sales into 25% is 100,000. Therefore, sales should be 400,000. Let's cross-check if this works. Let us say we make sales of 400,000. How much would be the variable cost? 75%, which would be 300,000. So sales minus variable cost, contribution would be 100,000. What should be the operating fixed cost? 100,000. How much is the EBIT? 0, break-even level. Are we fine?